Did you know you can lose your OAS even if you do everything right? Or that the CPP contribution requirement is now higher than ever? Most people miss these updates and it costs them tens of thousands of dollars over their lifetime. Fortunately, I've analyzed the most recent rule changes and I'll show you exactly what's new and how to get the most out of CPP, OAS, and GIS. So if you work in Canada, you've likely noticed CPP contributions deducted from your paycheck each month. And these contributions are increasing, but so are the benefits you'll receive in retirement. The Canada Pension Plan is a foundational component of retirement income for a lot of Canadians, and while it's not intended to cover all your retirement expenses, understanding how CPP works is important if you want to be comfortable later in life. This year, if you're between 18 and 70 and earn employment income, you're required to contribute 5.95% of your earnings up to $71,300, with your employer matching that amount. And for self-employed people, this means contributing both portions for a total of 11.9%, which is consistent with previous years. However, one big change is the introduction of a second contribution tier. Now, earnings between $71,300 and $81,200 are subject to an additional contribution rate of 4% for employees and 8% for self-employed people. And this enhancement is designed to increase your retirement benefits by having you contribute more during your working years. For example, if you earn $40,000 a year, you won't reach the second tier, so your total CPP contribution will be approximately $2,170 a year. If you earn more than $81,200, you'll pay the maximum contribution amount of $4,430, regardless of any income you earn above that amount. Now, the maximum monthly CPP payout at age 65 today is $1,433, but the average monthly payout is only about $900, and the difference here is because the benefit amount you receive depends on your entire contribution history, including periods of low earnings, career breaks, and opting to receive CPP before you reach the age of 65. To get a personalized estimate of your CPP benefits, you can just log into your My Service Canada account, but be aware that these estimates assume continuous contributions until the age of 65. So if you plan to stop working earlier, even if you delay receiving CPP, any years you didn't contribute will lower your benefit amount. Now, Old Age Security, or OAS, works a little bit differently from CPP, and it starts with how you qualify. There's no payroll deduction, no contribution record, and no paper trail going back decades. If you've lived in Canada for at least 10 years since turning 18, you're likely eligible to receive OAS once you turn 65. And that makes it feel like free money, but of course, there's a catch. Because while OAS isn't tied to your job history, it's still part of a system that adjusts, shrinks, and expands based on a few moving parts. And the two biggest parts are inflation and your personal income. Together, those two factors determine how much actually lands in your account. So here's what's new this year. OAS is one of the few government benefits that adjusts quarterly instead of annually, and that means that it responds more quickly to changes in the cost of living. Now, inflation has been cooling lately, so not every payment is increased, but year over year, payments are still up about 2%. And with each new quarter, those numbers can change again. And with OAS, your age also makes a difference. So if you're between 65 and 74, the maximum monthly payment rate now is about $728, but once you turn 75, that jumps to about $800, and that extra 10% was introduced in 2022 to help older seniors with rising costs, especially around healthcare, mobility, and other age-related expenses. But the OAS clawback is what makes things a little more complicated, because once your net income crosses a certain threshold, you start giving back a portion of your OAS through something called the pension recovery tax, and right now, that threshold starts at $86,912. So for every dollar above that, you lose 15 cents of your OAS. So if your income hits $100,000, you're giving back about $1,960. And once you hit about $142,000, then the entire OAS benefit is gone. So that's where strategy matters, because even though you can't control the base amounts, you can take steps to protect how much you actually receive. So if you have a spouse or a partner, then income splitting can help to lower your reported income, especially if one of you earns significantly more than the other. But if you're drawing income from a TFSA, you're in good shape because those withdrawals don't count as income, which means they don't trigger the OAS clawback. So while OAS is automatic while you're eligible, how much of it you keep depends on decisions you're making now. Small changes to your income sources can save you thousands of dollars over time, especially once you're into your 70s. But let's say you've already done all that with CPP and OAS, but you still don't have enough money to retire comfortably. Well, there's one more benefit that most people overlook, and it doesn't require any extra contributions, but it can quietly add over $1,000 a month to your retirement income if you qualify. So let's break down what it is, who it's for, and how to make sure you don't leave it on the table. So if you're heading into retirement with limited income, the Guaranteed Income Supplement, or GIS, isn't just another line in a federal booklet. It's one of the most impactful benefits available to low-income seniors in Canada, and yet it's still one of the most overlooked. The first thing you need to know about GIS is that GIS doesn't show up automatically. Unlike OAS, it requires an application, and whether you receive it depends entirely on your income from the previous year. Right now, the maximum GIS benefit for a single senior is about $1,087 a month, and to qualify, your income has to stay under a set limit, and that limit changes each year. Right now, if you're single and your annual income, not counting OAS, is below $22,056, you're eligible for at least some GIS. If you're married or living with a partner, then the income threshold depends on your partner's situation, but in most cases, the range falls roughly between $29,000 and $52,800. This calculation includes CPP, RRIF withdrawals, investments, and employment, but what it doesn't include is OAS. Makes the math a little confusing, but still important to get right. But what makes GIS especially valuable is that every dollar is tax-free. You don't owe any clawbacks and you won't see any deductions. The full amount goes straight into your pocket, which can make all the difference when you're living on a tight budget. But here's the problem. A lot of eligible seniors never receive GIS, not because they don't qualify, but because they either forget to apply or they don't file their taxes. And that last part is critical. Even if you made no income at all, your return still has to be filed. If the CRA can't verify your income, they can't approve your GIS payment. So if you're already receiving OAS and your income is modest, it's definitely worth looking into. You can do it online through your My Service Canada account or with a quick phone call to Service Canada. Either one will show you exactly where you stand. And if your income is just slightly over the line, there are still ways to bring it down. You might draw from your RRSPs earlier or shift some savings into a TFSA. Since TFSA withdrawals don't count as income, they don't impact your GIS eligibility, and that small adjustment could add over $1,000 a month back into your budget. Because at the end of the day, GIS only works if you actually receive it. And for thousands of retirees across the country, it's the piece that makes everything else fall into place. Now, once you know what benefits you're getting and how to actually qualify for them, there's still one more factor that matters just as much. It's not about how much you receive, but when. Because timing these payments correctly can mean the difference between a smooth month and an overdraft that hits when you least expect it. So let's walk through what those payment dates look like and how to make sure your money arrives right when you need it. So the federal government continues to use a unified payment schedule for all three of these benefits, which means if you receive more than one, they'll all land on the same day. Payments typically arrive during the last week of each month, and if the official date falls on a weekend or holiday, then your deposit will get pushed earlier, not later. It's a small detail, but one that gives you a little bit more control over your cash flow. And so to make sure you're not stuck waiting, set up direct deposit through your My Service Canada account. Payments hit your account faster that way and more reliably than if they had to mail you a check. And once it's set up, you never have to think about it again. And this may sound like a small detail, but in my view, this kind of consistency matters because when you know exactly when your benefits are coming in, you can schedule other payments and avoid any potential penalties. But here's the part that most people overlook. Just because your benefit arrives on time doesn't mean you get to keep all of it, because without the right strategy, a portion of that income could quietly disappear into clawbacks or taxes that you didn't plan for. And so that's why I say that knowing what you qualify for is only half the picture. The rest comes down to how much of it you actually keep. Both OAS and GIS are income tested, which means it's surprisingly easy to lose a portion of those benefits without even realizing it. For example, RRIF withdrawals are fully taxable, so leaning on those too heavily could push your income above the OAS clawback threshold of $90,997, which will cost you 15 cents on every extra dollar that you earn. So to avoid that, your TFSA is especially powerful in retirement. Withdrawals from TFSAs aren't taxed, and more importantly, they don't count as income when calculating your eligibility for OAS or GIS. So that gives you a way to access your funds without triggering any reductions. You also want to think carefully about when you start CPP. Receiving CPP early might help bridge the gap if you've stopped working, but it comes with a permanent reduction. On the other hand, delaying your CPP until age 70 increases your payment by up to 42%, which could add tens of thousands of dollars to your retirement income over time if you live into your 80s or beyond. And if you're sitting on RRSPs or RRIFs, start thinking about how you'll draw from those funds as well. Pulling out small amounts early before mandatory withdrawals kick in can help you level out your taxable income year over year instead of facing a steep spike that hurts your benefits later on. These aren't the most exciting moves, but they are effective, and the earlier you start applying them, the more they'll compound over time. And so the reason CPP, OAS, and GIS matter so much isn't just because the amounts have shifted, it's because more Canadians are relying on them as essential income. There was a time when government benefits were just a top-up, not the foundation of a person's retirement plan. But today, with fewer workplace pensions, longer retirements, and a higher cost of living, that balance has completely changed. These programs are no longer just support systems, they're lifelines. That's why understanding how they work on a deep level and planning around them strategically isn't optional anymore, because the decisions you make in your 50s or even your early 60s can echo with you for decades. And the difference between scraping by and retiring comfortably often comes down to how well you've managed these benefits. Because if they're going to be a core part of your future, it makes sense to get them right now when you still have time to act. So now you've got a clear picture of how CPP, OAS, and GIS work and how the right strategy can help you keep more of what you're entitled to. But there's something else most people overlook, because once you've optimized your income, the next smartest move is making your spending work just as hard. Because whether you're already retired or planning for it in the not too distant future, every dollar you spend could be earning you travel rewards, cashback, or perks that stretch your money even further. So if you want to find out how to start making every dollar you spend work for you, not against you, watch this video next.